Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So the main problem with a bull market is it is uphill all the way, and we've been trying to do that in January, coming off the lows. And even last week, we started to see the market struggle a bit. Tuesday, Wednesday, Thursday were down. Monday was a holiday. And then Friday was a big up day, which was options expiration day. And then Monday was a big up day, which was after options expiration day. So that's good. But I always want to make sure that's not a fake out. So Tuesday, the markets are kind of flat as I record this on Tuesday morning. But the point I want to make here is we are seeing some sector rotation into bull market behavior, and how to see that on the charts, what it looks like. And it never gives you the all clear, but it gives you an idea of things to look at and just try to make sure that we're on the right page of the market. So we're going to cover off some of the current market settings, the sector rotation ideas that I'm starting to see, and then the software industry is trying to make two legs up here after making some hammer candles a couple of weeks ago. And we want to watch and see if this is going to be able to follow through. If you like the work I do, you're more than welcome to go check it all out at Osprey Strategic for a 1-month trial offer at just $7. You can go check it out. Our work ends up being about $17 a week or something. But the big thing to try and keep in mind is if you want to go through thousands of charts a week, you're welcome to do that. Or we can do that work for you and we write up a summary for you, a newsletter that goes out, a video each week, and try to keep you on top of the major trends. So hopefully if there's anything there for you, come on over and at least check it out. So with that, I want to jump into the charts, and I want to start with the indexes here, and I'm going to start with QQQ and SPY. And on the StockCharts page under GalleryView, so that's up here, you can have two charts side by side, which I particularly like. But the other thing to know about this GalleryView is up here at the top. When you click on this, you can define what you want it to default to. So in this case, if I put point and figure and then did QQQ and SPY, then it's going to bring up point and figure charts, point and figure, yeah, and then QQQ, and then just hit go. What you see is it'll bring that stuff up for you. But the point I want to make here is symbol summary is one of the things StockCharts brought out, and it works really well. So it's your single thing. Guess I got to do that twice. Okay, SPY. There we go. And on the symbol summary, it brings up this page. And the idea of looking through here, obviously for stocks and ETFs and that kind of thing, lots of different data. Obviously, you're not going to have an earnings date on something like the SPY, but this summary page is very helpful. But the page I like the most always is the GalleryView. And let's see if we can reset that. And I'm just going to go SPY and see if we can get it. There we go. But I like being able to put up two pages at a time or two charts and compare them. Obviously, these are both index charts, but I could do something like software and oil and just have them side by side and just see which particular charts are interesting. So with that, the main idea here is not to get too hung up on the fact that we've broken out. What we want to do now is make sure we follow through. And as we can see on the software stocks here, we're banging on the resistance level, and I'll cover more on that later. And the real question for oil here is we're starting to get the 20 above the 50. We're starting to see lots of bullish price action in terms of the futures market. And we're in what's called backwardation. So that can help. But the idea behind this particular view that I'm showing here, the GalleryView, is that you can look at multiple things and then StockCharts has their default settings, but you're allowed to go in and change the weekly view to whatever you want it to be, or the daily view. And I guess I could just take another tab here. And the way you change those is below the charts down here, you have chart styles. And so for your gallery view, you're allowed to make a gallery daily, gallery intraday, monthly, weekly. And you can set up all of these charts to show exactly what you want to see. So whatever you make the chart look like under Gallery Weekly, that's going to be the third chart on this page over here. So that's going to be this weekly view. Anyway, you're allowed to set these charts up to view any way you want. I think the real value for me is I always like to compare. So as an example, if I'm trading an oil stock and maybe it's whatever, Devon Energy and XOP, the oil and gas exploration ETF, you can put these in and just take a look to see how close they're tracking each other. And as the market works its way higher here, what we want to see, you can see energy stocks like Devon had a really strong scooter ranking, and now it's been just below the 75. So it's average. It's not very good. XOP has been behaving a little bit better. But when we go look at something like semiconductors and IGV, when you look at these two, price action looks similar. But here's the difference. The scooter ranking for semis is saying price action is much better, and as you can see, it's making a series of higher highs and higher lows, and we haven't really seen that out of software yet. Now, if you caught the show last week, you had a great opportunity to get into semis on Friday and have a really nice push higher. The idea behind the markets is again, bull markets are hard to ride. So as we're trying to get through this prior high sequence, and now we're trying to come up against the August high, of course, things start to look good when we have a nice big, volume surge and everything starts to look rosy. And what we really have to wonder is, can the market continue? I think it does. And one of the reasons I think it does is because of the sector rotation that's going on right now, but obviously it can end at any time. We have a Fed meeting in roughly a week. And so these things are starting to be more impactful, because if the Fed is too bullish on the economy, stocks will drop, and if the Fed is bearish on the economy, stocks will probably do well. It's just the oddest conundrum ever. But what we can see here on the stock market, so I want to explain this chart again, and for some it might be review, but here's the market cycle. And what you see is the stock market goes up and it rolls over before the actual economy does. And then what happens is on the lows, exactly the opposite. The stock market starts to turn higher and the economy is still declining. So the stock market kind of starts to say, well, in the future, we don't see it getting worse. It can continue to bottom out, but we want to start investing for the ride higher. And then at the market top back in 2021, when everybody was all bullish and everything and the charts were rolling over, nobody wanted to believe it. So here we sit at this juncture, and it's a very difficult trading environment because we're really seeing price action being yanked both ways. And so if we're in an early recession, consumer expectations should be falling sharply, industrial production falling, interest rates peaking. Well, we haven't really seen the interest rates peak yet. We're still in this rapidly rising Fed. Yield curve hasn't even started to flatten out. It's trying to flatten out. It's been inverted for a long time. I think it was March of last year was our first inversion. And then, so you're sitting here with some of these, but what I'm not seeing is after this inversion is that the bond market is actually returning to normal yet. So you see this way over here, and this is quite we're so inverted that, I think some of the spreads were 40-year 40-year highs between the different terms. So we're in a really odd position here where we're, if the flattening out of the Fed was on the way up, we haven't seen a peaking of these interest rates yet, and everybody's predicting one. So are we here? This is an interesting question. Or are we here at the end of an early recession and heading into a normal with interest rates following and industrial production bottoming out? And that would mean the stock market should start to rally. When that happens, we want to expect these 4 groups or these 6 groups over here on the left to be the growth engine, and these 5 groups on the right. Financials, not so much, but the other 4 for sure, we want to see them, relatively speaking, underperform. So how do we see that on a chart? Well, one of the ways is to use this sector analysis tool. So this is performance, and I've set it up so from the end of last year to now. And what you see here is compared to the S&P 500, communication services has outperformed the S&P 500. Remember Meta that nobody wanted to own, and Google and or Alphabet. The really big change. And then you've got consumer discretionary starting to ramp up, just as everybody says, well, we're going into a recession, there's layoffs, nobody's going to have any money. And yet these stocks are already doing well. And then when we look at what's not doing well, it's all of the things that we would expect. So staples, healthcare, utilities. Financials is flat so far. Energy's been weaker than I would expect, especially based on the inventory data. And I think that's been a talk by everybody. But the real thing that we want to watch for is when is this market finally going to actually move into full growth mode, and this side's doing well and this side's doing awful. It never gets super smooth. The only thing that does happen is you can start to see like the whole market can go up together. It's just that always this left side would be outperforming the right side, and I think that's a pretty important thing. So anyway, down here at the bottom, you can double click on this and you can change the number of days in here. So if we go back, let's just pick to the October low. So this is December 8th. So need roughly 60 days. So October 26th, maybe 66 days or something like that, 67. There's October 17th. And so since then, everything's been up. And the real question is what's been up more. So materials is one of the top performers, industrials. Energy's been okay, and you can see that these technology and consumer discretionary have been some of the weakest. And then when we were, and this area over here was pretty strong. And then if we slide this back, heading into October 31st or October 15th, somewhere in there, what we can see is energy was doing well. The defensives were some of the best performing groups out there for the prior 3 months, but real estate was awful. And technology and consumer discretionary were weak. So when I say best performing, they were still negative, but they weren't as negative as some of these other areas. So when we hit the S&P 500 button, these ones looked okay. And again, this period would have been from July to October when everybody said we were in, somebody said the other day we started a big bull market last July. And I'm thinking, well, this doesn't look like a bull market structure to me. But now we're over here much more clear in terms of what's going on since the October lows. Almost everything's been up. Discretionary's been very weak. But if we go since the beginning of the year, we're seeing this growth area much better than everything else, and the defensives very clearly are underperforming. Now, they're not underperforming by a lot. They are compared to these two columns, but industrials or whatever, which was one of the stronger areas, has now it's only marginally better than some of these defensive. So there's a huge amount of shift going on from one group to the other. And as we start to see that happen, that becomes a problem. So, or not a problem, but something to be aware of if you're investing in these ones. These groups could actually meaningfully go down well, these groups go up. And the reason is because money's actually selling this and buying this and forcing even a good stock in a defensive sector lower. Okay, so that's some of the shift I'm starting to see. Now, how does that show up on a chart? And I think it's important to always be aware of relative strength. And we can do relative strength. There's 5 different kinds of relative strength that we can do. But one of the biggest ones that we want to talk about is specifically the relative strength compared to the S&P 500. And the reason to use that as somewhat of a benchmark is the S&P is this massive aircraft carrier with all the different sectors in it, and they're all big. And then what happens is as the aircraft carrier tries to turn, obviously it doesn't turn suddenly, but what we start to see is a shift in direction. And this chart probably lays it out, some of the better descriptions than ever. Here is the 2020 COVID run, and then heading into that, we had just started to see some outperformance of other stocks, and the staples group very, very weak. So in the second half of 2019, we saw a really good market rally. And what we saw out of the consumer staples is they actually were outperforming. They were some of the best sectors out there, or the best ETFs out there. And then they started to underperform. And all through the bull market of 2021 and 2022, 2020 and 2021, we saw this XLP underperform on the scooter ranking. And then in November, literally as the NASDAQ topped out, this started to become one of the top performing sectors in terms of price action, and then stayed up there for almost the whole year. We had a brief period late September to November where it started to weaken, and then it took back off for the rest of the year. And now it's clearly the weakest it's been in a long time. So to me, it looks like we're rotating into a new bull market. And again, this outperformance against the S&P 500 shown in purple, very clear trend ending early January. Back in 2020, it ended, right around the end of March and ended right around the beginning of the NASDAQ market top, and the S&P 500 obviously topped January 4th or something in 2022. So we have these clear markers showing up on this chart, not even marginal. It's been an absolute wonderful way to look at the market and just see what's going on. So between the scooter ranking telling us that it's no longer one of the top performing sectors, even though it's not that far off its highs, it's clearly starting to underperform the S&P 500 and has broken the uptrend. So to me, we're stepping into a new period, hopefully a period of a big bull market. Now again, the XLP went up through that period of time. It's just that it went up a lot less than the S&P 500 did, so it underperformed. So how does this chart calculate that? Well, if the S&P moves up on a week up 2% and the XLP, the consumer staples, only moves up 1%, the XLP underperformed the S&P for that week. And over a period of time, it kind of builds a trend, and that becomes more obvious. Now, one of the things that we've been doing lately, or I've been trying to do lately, is update this part of my chart where it actually shows it as a percentage change instead. And the way you do that is go to price performance. And when you see this, what happens, got rid of my colors. So let's just add that in. I always like to use this area chart, and I've set it up so it's always purple. And the reason for that is just when I look at a chart, I know exactly what it is. It's always my S&P 500 relative strength. And then to put a clean line on top of it, I use the simple moving average with a 1 period. And then that puts a crisp line right on top of all of my area chart. So with that, now we've got this percentage scale over here. And, worst case, it only underperformed by about 10% during the bull market. But again, 10% is a lot. If you could have just bought the S&P 500 instead of the XLP, you would have made 10% more money in the bull market than you did. So even though this was an uptrend, a simple change would have had you in the right area. And then we've been in a bear market for all of 2022, so it suggested being in there, and now it suggests being out of there. So that's a real quick example of how we can use the tool to show that. Now, if I go to XLI, okay, this is typically a growth sector. And one of the things that we saw that was really odd was the XLI was actually one of the top performing sectors for the last 3 months. And yet in the last 4 years, it has never been that strong. So this was a pretty big surprise. But one of the things to note is if we drew an uptrend on here, we've broken it now. We also have one other uptrend line that we could draw if we wanted to, and that would be something like this. And until we come down to that, again, we'd still be in an uptrend. But the real question is, do you want to wait for this to get down to minus 5% outperformance? And again, it goes back to the beginning over here for where that scale started from. But my main point would be, all of a sudden, this little uptrend that we had going is now broken. So XLI hasn't been as strong as we might have liked it. And I'm just going to save these in a different place here. So this is kind of an interesting switch, that from the fourth quarter to all of a sudden in January, it doesn't care. Now, if we put up XLU, same thing. We had an uptrend, then we broke it, then we had a small uptrend, and now we've broken it again. Look at the scooter ranking. I think it's even clearer on the scooter ranking, showing us that it's it's underperforming by a lot. It's one of the worst ETFs out there right now, even though this doesn't make it look too bad. And so what's happened is other stuff has stepped in front. So if we go look at XLK, now what we see here is the scooter ranking starting to tick up, and we've got a relative strength line on here that is breaking. And, in general, for this whole move up, and it looks so easy when we draw the lines after, but living through this pullback in here, you'd start to wonder if this was going to be a big market breakdown, and sure enough, it turned and resolved to the upside. So I'm trying not to oversell it or whatever, but I think we still have this trend line to kind of overcome for technology. But if we were about to start breaking out to a new bull market, this should follow through. Again, when we look at that XLU chart and the XLP chart, it's starting to break down. So these are ways that we can watch the different market rotation and see it, I'll call it in real time, what's changing. And when we look at energy, this is an interesting one. What you see is energy continues to outperform. Scooter ranking's been one of the best all year. It hasn't been easy. This was from 90 to 64 in 1 month in June. It literally dropped a third while we were, quote, in an uptrend. And then after that big drop, it's basically been working its way back to get up to $90. And you can see today we're sitting at 89.62. So that prior resistance is pretty big deal. We briefly broke it in October, November, and then fell apart again. But we still have an uptrend in energy. It's one of the reasons I like it, but I sure do want to see this uptrend break, and we're sitting right on this line right now. So all of these different looks are starting to make us at least be aware of the change going on around us as we start the new year. When we get into things like consumer discretionary, which should be one of the big ones. What we see here is there was a real downtrend for the last 4 months, and now that's starting to break out. The full stochastic starting to turn up. Scooter ranking hasn't even started to move yet. But one of the things I always like to look for is the momentum change. And so we can draw a clean line down here. We can draw a line down here and suggest that something's changing. At least it's trying to improve. And again, it sounds like, oh wow, XLY has underperformed by so much. Over a 4-year period, it's underperformed by 10%. Let's try to keep it in context. Now, some of the stocks in there, like Amazon, have been wiped out 60%. But at least we're aware of the change. All of a sudden, we're starting to see, since the beginning of the year, some improvement. Full stochastic turning up, hasn't really done that for 3 months. At least it's starting to run. And the real question is it going to go to new highs? Is it going to break this trend line, or is it just going to get stuffed as we get there? I do like the fact that this momentum trend is changing. There was a momentum trend in here that broke out, and that was a pretty good one to be a part of. But again, it rolled over, and we want to be constantly aware if it's going to roll over again. Okay, so with that, hopefully I've helped describe how to analyze for sector rotation and given you some ideas of some of the things to look for. Thank you. Have a great week. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.